Morning, everybody, and welcome to our panel titled The Case for Flexible Income Funds. Very tough gig to follow, going from the future of asset management into fixed income. Not everybody's favorite asset class, but we're going to try and make it as exciting as possible. Hopefully you'll get a few nuggets out of it. I'm joined on stage by really, I would say, three giants of the South African fixed income world. We've got Conrad Wood from Aluwani. He's head of fixed income and portfolio manager. Bronwyn Blood from Granite, also head of fixed income and portfolio manager, and Sylvester Kobo, who's deputy head of fixed income at Stanlib and portfolio manager. So thanks for giving us your time, guys, to pick your brain a little bit. So I think, quite a bit to cover, and we'll try and cover it in 30 minutes. But what we want to do is explore some of the benefits of using flexible income funds, but very importantly also some of the risks. And also cover how are these guys positioning their funds for the current environment. But I guess before I jump into the actual discussion, let's just be clear on what we mean by flexible income funds. So there's 4 ASISA fixed income categories, right? Starting with money market all the way up to variable term. And each category is pretty much defined by the type of paper that it can buy, the duration of the paper that it can buy. The category with the least constraints is the South African multi-asset income category. And when we talk about flexible income funds, that's the category we're referring to. So very broad mandates, you tend to get the manager's best view of the world. And for me, the most exciting and interesting of the categories, these funds will tend to target a return of 1 to 2% above the STEFI sort of composite index. And just to give you a view of, how is the retail market directing their assets across these different categories. And Lee mentioned, the great inflows into multi-asset income over the last quarter, but that's been a trend now for a good few years. The money market, in the dark blue bars here, we've got the total assets in that category, and the light blue is the number of funds, unique, distinct funds in that category. And for many years, money market used to be, the biggest category by far. But multi-asset income, is now pretty close to the size of money market at just over 300 billion rand. But you've got 142 funds to pick from. That's astounding. So more than 2.5 times the number of funds that are available in money market. So it is a minefield to navigate, which are the best funds to buy. So let's jump into some returns data. So what I'm showing you here is the returns of multi-asset income divided into quartiles for the last 2.5 years. So 2.5 years till the end of August. And the reason why I chose 2.5 years is because the Aluwani Flexible Fund was launched then. Although, Conrad, you've been managing flexible income mandates on the institutional side for many years. But we wanted to show you a retail fund here. We're using all the list classes of the fund. So you'll see the range of returns here. I think the first thing I want to point out, what's happened? The first thing I want to point out here is that little blue dot. That's the average money market fund return. And what you can see here is just about every single multi-asset income fund has outperformed the average money market fund over the last 2.5 years. So let's just try and unpack why that is the case. So, And I mean, what's really great also is that our panelist funds are all in the first quartile. But maybe, Conrad, let's start with you. Just tell us about, what are the tools available at your disposal that gives you this ability to outperform money market by quite a handsome margin at times?
So thanks, and morning, everyone. I think the first point that would be fair to make is that money market was easy to beat, right? Because of the 2.5 years, rates were at 3% during COVID for most of that period. Okay, so I think this picture looks different for different parts of different cycles, but a good flexible income fund should consistently deliver above money market. We target 2% in our fund, and it really talks to the tools you have, the broadness of views that you can take, the ability to be tactical, to be active, and that offshore component as well can help in portfolio construction, given the general depreciating path that our currency follows. So I think it's, as Lee said, it's possibly the best place to tap into a manager's full set of views, which you need to take. And if you do that properly, so asset allocation, duration, stock picking, credit, you should compound and beat money market easily over time, should I say.
Brilliant. So much, much wider toolbox, much more diverse set of opportunities at your disposal. But, I mean, Sylvester, look, everybody's got the same toolbox in this category, right? There's not any constraints here. So what is the secret behind being able to deliver first quartile performance? You know, you're up against the competition, everybody's got the same tools. What's your secret to delivering such good returns?
Thanks, and morning, everyone. So, I mean, for us, the last 2.5, 3 years have been quite tough. There's been a lot of volatility in the market, and, you know, which suited our style, given that we are more active than your normal guy. You know, we actively move our asset allocation decisions around. We're very active duration managers. You know, I mean, in the last 3 years, it has ranged from, you know, half a year duration to over 5 years. And that for us has been the secret sauce, you know, actively looking for all the dislocation in the market, because with volatility and uncertainty comes a lot of inefficiencies. So we've been, you know, I would say, successful in exploiting those for our clients.
Okay, so being quite flexible on things like duration and trying to time markets correctly, I guess, at times.
Yeah.
Bronwyn, let's hear from your side and give us some insight into your toolbox. And are there specific levers and tools that you focus on in the management of your fund?
Yeah, I mean, I think Conrad mentioned a good example. So during COVID, we had the repo rate decline by 300 basis points, and obviously money market was easy to beat. But if you were stuck in kind of the short end of the curve, you weren't going to beat CPI plus 3. So you needed to be active and nimble and move your duration out very quickly in the income space in order to get those returns. And that's exactly what we aim to do. We aim to kind of be nimble and flexible and utilize the opportunities that are available to us at the right time in the cycle. So for instance, now we've got very high real yields because we've had repo rate increases. So now the short end of the curve is looking more attractive. So we're moving our duration down. So we can play that full spectrum of the yield curve. Obviously not too much duration because that's, you know, within a certain risk limit that we've got. But yeah, I think it's just being flexible, nimble, utilizing all those opportunities that are available at the right time in the cycle, which obviously you don't always get right.
But I mean, aside for duration and your bond positioning and your yield curve positioning, there's other cool like asset classes that you guys are buying that some of the other bond funds and that can't buy. Just give us a bit of a sense of like the type of credit and other type of cool instruments that you use.
Yeah, there's many. I mean, there's inflation-linked bonds, for instance. You know, I know you wanted to ask me on that topic, but inflation-linked bonds, corporate bonds. You know, there's a whole corporate sector of issuance. There's structured type opportunities. You can invest in listed property in this sector. Obviously, you know, not to a large extent.
Offshore?
Because offshore credit. So, you know, there's many different opportunities. At the moment, you know, we're finding, for instance, credit in the local space expensive, but in the offshore space, it's quite cheap. So there are opportunities to move kind of in the offshore space and utilize our offshore allowance that we've got.
Brilliant. So the other thing I want to point out on this graph is that the little green dot, that's the CPI plus 1% return over the last 2.5 years. And what you'll see is that probably only 25% of these income managers have outperformed CPI plus 1% over the last 2.5 years. And that tells me this is not an easy mandate to manage, right? There's complexities, there's a balancing act involved. Conrad, tell us how you balance risk and return. And like, why haven't the Oaks been able to generate CPI plus 1 over the last 2.5 years?
Because Ukraine and Russia were fighting, essentially. I mean, so a CPI-linked benchmark is a difficult thing because inflation can be incredibly low and stable, or it can be high and volatile. So we've seen the low equity funds go through CPI benchmark misses. We've seen the absolute return funds not be able to make it. And multi-asset income is now in that space where it's used as a benchmark. And there's no holy grail, to be honest. If inflation's going to be 8 or 9%, you're going to struggle. And if inflation's going to be 4 or 5, like it has been over, the last couple of years, it's going to be much easier. So if you're looking at inflation as a benchmark, take a through the cycle view, and then we can talk about how much is feasible or sustainable in order to beat that. So, I mean, for us, these funds are as much about risk as return.
Yeah.
So absolutely go for the extra yield, be flexible, be active. But our fund looks to achieve no negative quarter and no underperformance of money market or STEFI on a 1-year view. So that puts the brakes on from a risk perspective. I can't be at, 5 duration or 15% in listed property or even 10% offshore and still deliver on those risk outcomes. So it's about diversifying risk, as Bronwyn said, allocating to the fixed income areas that are going to perform at that stage of the cycle, but understanding if you're wrong, and we'll talk about drawdowns just now, when those drawdowns come through, that it doesn't blow the fund out the water if you have got downside sort of targets like we have.
Yeah. Well, Sly, I guess it's very, do you think about real returns when you're managing this fund? And ultimately, that's what matters to clients, right? If you're not delivering good returns above inflation, the client is worse off. So are you really thinking about real returns as like a central part of how you manage the fund?
Yeah, sure. I mean, that's the promise we make to our clients, right? And to echo, Conrad's sentiments earlier, you can be as racy or as conservative as you want to be in this mandate. So risk management processes are key. I mean, for us, in trying to achieve that sort of your inflation plus 2-3% consistently over time, we've got very sound and strict risk management processes. It's not just about, for us, as I hear Conrad saying maybe, he won't go to 5-year duration. We can go to 5-year duration. But holistically, when you look at the risk of your portfolio, it needs to make sense.
Yeah.
So you can easily go, say, 70-80% bonds, go to 5-year duration, but then look at the correlations of the other asset classes that can, lower the risk in the portfolio. For instance, cash has negative correlation to nominal bonds, so you can hike that up, or you can buy dollar rents. As you know, normally when things go pear-shaped, the rent weakens, so that lowers the correlation in the portfolio. So it's a very holistic approach, risk management approach to, in the end, over time, give our clients that, CPI plus 2-3% consistently.
Yeah, so the ability to diversify across uncorrelated assets, a big advantage in this space. So that's a good segue into risk. Yeah. Let's talk risk. So what I'm showing you here is the drawdowns of our 3 panelists' flexible income funds versus the drawdown of the all bond index, which is in green here. So clearly, definitely, these flexible income funds can experience 1% drawdowns from time to time. That's, normal course of things, but nowhere near the extent of the bond market itself. But Bronwyn, tell us, why do these, why do you see these drawdowns every now and then, and what are you doing in your fund to minimize those drawdowns?
So I think the reason is, if you are targeting CPI plus 3 and you're in a negative real yield environment, you cannot get CPI plus 3 by just sticking to the short end of the curve, as I was saying.
Risk, yeah.
You've got to move up, you've got to take some duration, and if you've got a steep yield curve, you're going to take opportunities. The bond curve was giving you CPI plus 5 in some instances. So you have to take that interest rate risk to get to your benchmark if you're mixing it with negative real yields in the short end. So that is why you get those drawdowns, is because you are taking on interest rate risk in the fund. But we do manage that within constraints. I think all the panelists mentioned. So our max duration is 2. So that restricts us in terms of taking on too much interest rate risk. So that's why you won't see the drawdowns exacerbated like you see in the all bond index. It won't be anything close to that.
So 3 very different approaches to risk. That's what I'm getting here. Sylvester doesn't constrain his duration. Bronwyn, the fund's constrained to 2 years. You tell us, Conrad, your fund, what's the max duration? And tell us also how you think about risk and what other risk management protocols you have in place.
Yeah, I think so. Our max duration is 3, and that's not just a number that comes out of air. It's the max duration that we think is appropriate for those downside targets that we're trying to deliver. If you're going to go more than that, you're going to miss those downside targets because you do get it wrong. I think the nice thing about drawdowns in the local fixed income market is that they normally happen in extremes. So it's your Pala-Palas and your Lady R's and your COVIDs and your Nene-Gates. Maybe a credit default here and there are the drawdowns, and then they tend to recover quite quickly. So you tend to bounce back. Now, that's not a guarantee, and it's getting less and less likely to keep happening by the looks of things. But the recovery is quite quick. But it's about allocating risk appropriately, and then just testing for, if you're wrong, what's the outcome that materializes in the fund, and do those risk parameters hold, and the promise to your clients, does it hold? I don't mind a drawdown short, sharp over 1 month or 2 months. It's when it's persistent and when it's often that one needs to then look at the risk-return balance.
Yeah, I think you've got to think about the type of client that's buying this fund. Look, it's not a money market fund, right? You got to have an appropriate time horizon. That takes me on to my next point, and the ability to stomach a little bit of volatility in order to earn those better returns. So what I'm showing you here is the rolling 1-year returns in green for the average multi-asset income fund, and in blue for the average money market fund. And I think what you can see here, on most occasions, the multi-asset income does outperform money market on a 1-year basis, but there's many times where multi-asset income can underperform money market over a 1-year period. So, that tells me time horizon is quite an important aspect if you're going to buy this fund. Bronwyn, tell us, how do you think about time horizon? What would you recommend to the investors here, as an appropriate time horizon to come into your fund?
I mean, we've always said 3 years, and I think the reason for that is because you go through cycles. You go through cycles of negative real yields, positive real yields. So in order to get CPI plus 3, I think you need 3 years minimum. At least. Okay. And that will obviously, enable you to kind of stomach some of that volatility, but over the long term, longer term or medium term, you should get that CPI plus 3.
So, Sylvester, I mean, if you're running a duration of 5, is 3 years appropriate for the clients? Do they need a longer time horizon?
It is. I mean, not to sound like we cowboys. We adhere to very strict risk management processes. I mean, Conrad was saying earlier around, understanding or, shocking your portfolio for different scenarios. For instance, we would look, so we can run a duration of 5 years, but any point in time, so we'll do scenario analysis, shock it for if, say, COVID conditions were to come back, or Lady R, or your, EM debt crisis, how would the portfolio perform? If that's not within our risk budget, then we would, tame it down. So over time, definitely 3 years, we're comfortable. We can,
okay.
Deliver that CPI plus 3.
Okay. So before we move into how your funds are positioned, one question I think is on most advisors' mind all the time. I get this question. You've got some of these banks, right? The one I was looking at yesterday is Time Bank, is offering 11%, on a 1-year fixed deposit. Why should we buy a multi-asset income fund when you can get such an incredible return with a bank deposit? Conrad, let's hear your view on that.
So I wouldn't take the whole fund and put it into Time Bank. That's the first thing. And nothing against Time Bank. It's diversification. I see this argument all the time. You have it in money market fund space and income space. Banks have different reasons for offering preferential rates at different times. Time Bank is new, it's starting up, it's small, not well known, it needs to attract capital. African Bank offers higher than that, I think. At any one time in the cycle, there's going to be a fixed deposit rate higher than a multi-asset income fund, probably. Multi-asset income funds, that diversity, that flexibility, and you can take your money whenever you want. So it's not a great comparison. Also, that's a 1-year fixed deposit rate, so your money's there for a year. I mean, sure, put some money in Time Bank at 11%. I don't have a problem with that, but it's kind of apples with oranges, I think.
It's a different need.
And it's a different yield. Through the cycle, I haven't looked at it, I don't have data, I would venture to guess these multi-asset income funds beat fixed deposits comfortably through the cycle.
Yeah, I think the issue is, look, if you need to access your money before the time, you're going to pay penalties in that. Bronwyn, anything to say about that?
No, I think fixed deposits are a good option if you've got a specific need for an amount of money at a specific time. So in a year, I want to save this amount of money and use it for X. But multi-asset income funds should give you CPI plus 3 through the cycle, or that's what at least we aim to do. And they do have that flexibility. They do have that flexibility that when things change, at the end of a year, rates could have plummeted like in COVID, and then you can only get 5%, whereas multi-asset income through the cycle will asset allocate appropriately. And over time, you will get that CPI plus 3, and you get that flexibility.
Yeah, so the opportunity to earn better returns, liquidity if you need it, great.
Yeah.
So let's go on to positioning as our last slide. So we just broke down the sort of high-level asset allocation of these three funds to draw out some differences. The one that sticks out for me, firstly, is Sly. Look, I mean, we're all reading the news now. Our government is missing their revenue collection targets. They're probably going to have to issue a lot more bonds going forward. But your fund sitting with 60%, in South African government bonds, you're running quite a high duration at 2.5 years. What is the thinking there?
So, I mean, one speaker was saying earlier, there's a lot of negativity currently around SA, right? And also, I mean, the facts that you're mentioning now around constrained fiscal numbers and all that, it's well understood, it's out there. And, we believe fixed income markets are efficient, so we think they efficiently priced all this information, even at points punitively so. I mean, if you look at the bond curve now, some of the spreads are actually at the highest that, of 2020 during COVID, when there were fears or worries around the government probably defaulting or doing a full-blown IMF and so forth. And the government then was issuing at double the rate that they're issuing now. So, I mean, we think the bond markets have been punished, or rather, the valuations, are sticking out very well for us. So, we're comfortable that,
Okay, so it's pricing in.
The valuation is there. But more importantly, I mean, some of the risks that you're pointing out are in the longer end of the curve. So they would play in the 20, 30-year part of the curve. This, for us, as an income fund, we do not invest in anything over 10 years. So we do more, that call, or that high conviction call of 60% allocation to bonds, is more around monetary policy trajectory. We think the money market curves are not sufficiently pricing in the cuts that will come both globally and locally. We think, to the end of next year, we'll get about between 100 and 150 basis points of cuts, which is why the duration is high in the portfolio. But to my point earlier, when you look at the portfolio holistically, you will see cash is high because it's negatively correlated to bonds. Same ILBs, or inflation-linked bonds, for us, they have a higher correlation to nominal bonds or SA govies, so we do not have much allocation there.
Okay.
And
so you're balancing the risks.
We're balancing it around. So holistically, when you look at the portfolio, you can look at one number, say 2.5 years, and say, sure, that's high. But from a risk management perspective, there are certain factors that water that down for us, which makes us comfortable.
I hear you there.
Yeah.
Conrad, very quickly, we're almost out of time. The one that sticks out for me is your credit allocation, right? And I think credit spreads are quite low at the moment. So what's the thinking behind such a high allocation there?
So just to be clear, we call almost everything that is non-government credit. So that's quite a wide category there. Anything that doesn't fit into the asset allocation that you have there, we call credit. So it's going to be corporates in there. It's going to be banks. It's going to be some SOEs. SOEs got a separate category. Credit spreads are narrow relative to history. I don't think we would go and look at an equity price and go, well, Sasol's trading at 250, so it's cheap relative to history because it was 600, right? So why do we do it for credit spreads? We actually think investors have been overcompensated for risk in credit spreads historically. Yeah. The quality and the way the credit market has performed and what you've been paid in spread, we actually think has been too high.
Okay.
So the fact that we're low now, yes, absolutely, be cautious. The macro backdrop isn't exactly great for credit, but we think there's some fat in there if you're selective, and if you pick your battles, we think you're getting more than well paid for investment grade credit risk. So it's a valuation thing, and it's a little bit of a contrarian view, but the numbers don't suggest that credit is expensive or that it's going to underperform.
Okay, so back at sort of fair value.
Yeah.
The glory days for credit are over, basically. That's what you
Yeah,
sort of
absolutely.
saying,
There's
yeah.
been a major re-rating.
Okay. Bronwyn, just in 30 seconds, tell us, there's a big other component there, right? That's like a fifth of your fund. Just unpack that for us a little bit.
Yeah, so I mean, I think it's a good thing to actually say after Conrad's thing on credit.
Yeah.
I mean, I actually think credit is expensive, and if you take a government bond and you overlay a swap, you, in some cases, getting a higher spread than what you'd get on a bank credit instrument. So that is what that is structuring certain instruments to get the yield profile you want. So a credit spread above a government bond, let's say, that's actually higher than you'd get in the credit space.
Okay.
So a lot of that is structured type opportunities.
Okay, that's
Yeah.
quite interesting. I wish we had more time to unpack that, but we're out of time, guys. Look, I think from my side, the point I want to really drive home here is, look, not all income funds are built the same way. Clearly, you can see very contrasting views, all doing different things. Their risk-return profiles are different. But where we add value as a DFM is being able to, firstly, identify who those gems are, those fund managers that have a high probability of outperforming out of the 140 plus funds in the sector, and secondly, blending them together in a robust solution in an optimal way, that you can deliver to your client, and it's like really diversified and the risks are minimized. That's it from our side. Lady and gentlemen, thank you very much for your time. It was a pleasure.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.